How's it going, guys? Lee here. It's been a while, I know, but trust me, I have a good reason. We've recently have just moved homes. We've actually just purchased and settled on a home. So I've been waiting for the internet to plug in and everything else to be set up before I could do a video. We have a new layout for the studio, which is why at the moment it's kind of blank, but we will get some stuff up there so you guys have some visual cues and just things to stare at, except for just a white wall and a white sweater that I'm currently wearing. But yes, so in this video today, we're going to be covering the most bought stocks in September in the ASX. Now, before I move on and I talk about these stocks, obviously this is a list from Commsec. I'm not telling you that you should buy any of these or sell any of these. Just giving you some of my thoughts in the different fields and industries that they're in, where they're starting to head or where they're not heading to. Now, given this is a list from Commsec, it only does include traders and investors from Commsec itself and doesn't include all the other brokerages that are out there. But with Commsec being the biggest broker in Australia, obviously this is a solid data set. Anyway, guys, without further ado, I'm going to continue once you smash that like button just down there for the YouTube algorithm, and also subscribe if you haven't done so. And please stick till the end of this video as I do have some announcements on the way. So moving on to the first sector, we have the banking sector. Now, in regards to banking, we all know that interest rates are at an all-time low, which for many of us might scream, uh-oh, this is a bad time for the banks, which is why we've seen a dip in their share price, all four of them. But in saying that, if you've actually read the recent reports that have come out, it's actually contrary to what we might be thinking. Because what's happening right now is obviously we've got the home building grant that's going out to everybody, which for many can total up to $40,000. Now that's a lot of money. I mean, and for some people that might be a 10% deposit into their home that they want to build. And so because of these grants and low interest rates, actually the amount of people taking out the home loans has actually increased drastically, which has kind of offsetted the lack of interest rate, or sorry, not lack, but lower interest rates that we're currently seeing over in the US and also in Australia. Now, from what I've seen, the best two performing banks at the moment are clearly ANZ and CBA, who've both paid out a dividend and have stuck to the APRA guidelines of paying out about 50% of their profit in dividends. Now, the biggest news out of the top four banks that's just recently come out is Westpac's money laundering issues. Now, I'm personally a shareholder of Westpac, so it kind of looks bad, but having a look at this share price, it hasn't shifted too much, and I think people have been anticipating this heading into it. They have copped one of the biggest fines ever dished out by Austrac of $1.3 billion. Now, moving forward, I think the banks will do okay. I'm not going to say that they are going to do quite great, but moving forward, I think they'll be quite well positioned to continue operations as is. My only concern is all the loan or mortgage deferrals that have taken place. People who, for a certain period haven't been paying their bills, their mortgage repayments, are going to see a nasty bill later on when they start having to pay back all this money, plus the interest that they've been incurring in the meantime. So it's not going to look great, and I really don't know how it's going to shape out. You might have a couple people selling their properties. I don't know what the case is going to be, and it will really be dependent, obviously, on what the government implements in terms of any bonus job seeker payments and if they're extending that moving forward. Now, if you had to ask me, Lee, what is one bank you would buy and kind of not sell ever? Or even one stock that you would buy in the ASX and never, ever, ever sell? That's an easy answer. For me, it'd be CBA. Most profitable, the biggest bank in all of Australia. Now, however, they are trading at a premium when you look at the share price in comparison to the other banks that you could be investing in. Moving into the next sector, obviously we have the travel stocks. Now, the travel stocks haven't really traveled anywhere.
Do me a favor, please. Get out of here.
Obviously, borders are still shut. The amount of cases of the Rona is still increasing around the world. We've got our own major lockdowns between different states in Australia. And yeah, I just don't see travel picking up anytime soon. And previously, Qantas had indicated that international travel might take off in mid-2021. I don't even know how that's going to work if, cases are still increasing over in the US, in parts of Europe and whatnot, like where people are willing to travel to. I imagine maybe a lot of trans-Tasman traveling between Australia and New Zealand. That's probably about it. Maybe Vietnam, where they haven't had any, severe cases that have grown from there. So yeah, I don't know where the travel sector and the travel stocks are really going to go. But what I will say is, in regards to the travel stocks, tread carefully. We've already seen a decline in recreational travel prior to the whole Rona situation as well. A lot of news outlets and even the travel companies had reported on this previously. So be very, very careful about purchasing the travel stocks in the hopes that things will just take off very quickly and very soon. Now for the next sector is the Australian tech darlings in the buy now and pay later segment. Right? So this is, I guess, the equivalent of when Australia created Wi-Fi back in the day. We've now got buy now, pay later, and are the leaders for that in the whole world. Now, the volatility that comes with buy now, pay later, I would relate it to maybe like a Tesla equivalent, because the shares go up drastically and then they go down drastically and nobody kind of knows where they're going. Everybody's taking, a stab at the buy now, pay later segment, and some people have profited greatly. A lot of people have actually profited greatly. And then some people who come later on in the end are quite sad about that the shares go right back down. Now, if you guys have seen some of my earlier videos, obviously you know that I've made some money in Afterpay, which I wish I had kept in there, and I'm quite sad that I haven't, because then I could have quadrupled my money. But it is what it is. Hindsight is a massive pain in the back. And in the past couple of months, I put out videos about all the other buy now, pay later companies, Zip of which I am invested in, full disclosure, of course. And I have made some solid gains along the way. And I know a couple of you guys have made some gains in Zip also. Obviously, all my content is general advice. I'm not telling you guys to buy or sell anything. We both kind of know that, but just making it very clear out there for everybody else. Now, if you're going to put this in the comments below, please don't ask me if you should actually buy a stock at whatever price, because I will give you the same generic answer that you should buy it if you think that it's going to go up, and if you don't think that it's going to go up and that you can hold on for the long run, then don't buy it, okay? But in regards to the buy now, pay later model, I don't see this in the long run lasting well for all the companies that are in the space at the moment. And here's why. So, we know that buy now, pay later is essentially a vehicle to drive customers towards, different vendors and different shops, right? So there's two purposes for them. One is to drive customers towards the shop, and the other one is to help conversion rates. Because if you're not willing to pay for it now, you can still buy it now and pay for it later. And for the vendors, they just have to sacrifice, the 3%, 4%, 5%, 6%, whatever it is that the buy now, pay later company is charging them. So that's kind of the transaction there. Now, what happens is that in the future, at some point, if the brand is good, if the company is good, they're going to start to build a loyal following of customers. And in that case, then the buy now, pay later company, maybe OpenPay or whatever they decide to use, isn't able to drive any more customers over there. So is it still worth keeping those guys around? Maybe not. Probably not, right? So I foresee that maybe one or two of the big dogs will stay there and stay relevant, as the other ones start to slowly fall off, just because they're not driving as much traffic as they used to. And because all the products are quite similar, the one that's going to rise to the top is the one with the most marketing, so awareness for other customers to use and refer their friends to. Number two, also has the greatest ease of use, right? Is the app very good? Is it easy for me to just tap and pay and that's it? Kind of like PayPal, how they've integrated into everything, of which they're trying to enter the market. But anyways, that's another topic. So personally, that's my thoughts on buy now, pay later moving forward. I think only one or two will stay relevant. Afterpay for sure will stay relevant, just given their marketing, the awareness, and how big they've become. It's one of those things where they become as big as like a MasterCard or a Visa. Like, it's just too big to ignore. As for the other companies, I really don't know. Now, the next group of stocks is in the ETFs and Rona or biotech related stocks, right? I'm not going to go over to the biotech side because I've already done that in the previous video. So please go check that out, the one in August. But with the ETFs, what's interesting to see is that a lot of people are wanting to get their foot into the US market, but don't want to deal with the barriers of, having to exchange their money, opening a different brokerage, and then going into it and individually picking stocks. So what they're doing is a lot of Australians are starting to invest into NDQ. and I've received a couple of questions about it. I think it's a great ETF to get exposure into that market, only if you want to, of course. And we can see that in the US market, they are taking off and reaching higher highs. I mean, some of the tech stocks are just going crazy at the moment. And given they are tech stocks, they're taking advantage of everything that has to do with online, has to do with entertainment, which is capturing a lot of our time and attention at the moment. And so yes, at the moment, NDQ is taking off, and thank you to BetaShares for making all these crazy different types of ETFs to give different people different types of exposure that they want. Now, the other one is iShares iOz. I have a feeling that one is just a general broad diversification for investors who don't know what to invest in, or don't want to take the time to personally pick stocks, and that's okay. I think investing should be like a boring thing, and you should just go enjoy life, or go and try to increase your income, which has a greater, higher return than you trying to pick individual stocks with the small amount of money that you might have. Now, what's interesting on this list for me is iCandy. Now, I was thinking when I saw that, I'm thinking Candy Crush, like iCandy, it's a mobile app, Candy Crush. But it was rather close. My guess was rather close. It's actually a mobile gaming company in Australia. So now these shares popped off because they've recently had an agreement with Alibaba to expand over in the Chinese market and get their games out there. Now, nothing is finalized at the moment, so people are betting on the prospects that it does get finalized and that these games can deploy and go over to China. Now, I haven't delved into it into great detail, but I had a look at some of the games on the Android and the iOS platforms, and a few of their titles have received really good reviews. But if you know anything about esports, a lot of the hype doesn't necessarily equate to profits or businesses doing well. Whilst the athlete in the esports game is doing well, they're receiving a good salary, the businesses might be suffering at a huge loss. So having not delved into iCandy's financials or what they're looking to do in the long run, I'm not too sure and can't really give much more insight to it, so I'll just leave it at that. But very, very cool to see that a mobile gaming company is on this list, and thank you so much for people who were trading it, because now I've just been exposed to a totally different sector in the ASX that I had never ever even looked at previously. Now, if we're looking at the top two stocks, we have BrainChip and also Novonix. Now, I haven't looked into these two stocks in my channel, but there are so many other Aussie finance channels that have already done so. So please feel free, have a YouTube, have a Google of them after this video, of course. After this video, to see what the companies are all about. But let me just give you a general gist about these companies and why they are the top two traded stocks in September. Now, BrainChip is essentially an AI technology company and gained a lot of hype around its processor that was validated, which saw the shares drastically climb up around news about also its expansion globally. Now, I personally avoided it entirely just because I know that when things get hyped up this much, there's generally a crash that comes right afterwards. And this is what we see, right? BrainChip has taken a massive crash from its all-time highs based on the hype leading up to it. Now, will I look into this company further later on? Yeah, potentially, but honestly, I just have no interest in it. And if you've made money along the way, that's great, that's good to know. But just because shares are going up, please, please, please be careful about purchasing them. Just because, video has been released or some news announcements that's come out to hype up the whole thing. The tech sector, yes, it's great at the moment. Yes, it's booming, but I would just be very careful about what you're buying and make sure that you've informed yourself well enough into the purchase so then you have no buyer's remorse once the shares start, plummeting into the ground. Now, another spec stock that's at play is Novonix and its battery technology, which has only been relevant due to the potential partnership with Tesla. Now, I think a lot of investors have come into it thinking that the partnership with Tesla was going to be announced on Battery Day, which, well, unfortunately, it hasn't, which saw its share price drastically go down. Now, much like BrainChip, I really have no interest in Novonix. It's just another spec stock. If you want to go into it, you can obviously be well informed about it. But what's very important to know is that also, again, with these spikes in share prices, especially with some of these penny stocks, it's so important to know that investor expectations are at all-time highs, especially people who are trading with large volumes of 10,000, 100,000 shares in some of these companies. And so just like the buying volume can drive the share prices up, the selling volume drives it back down drastically also. So be very careful about just buying in some of these spec stocks unless you truly truly believe in it, or you just want to take the risk because YOLO, right? Anyways, guys, thank you so much for sticking to this point of the video. I hope you got a lot of value out of it, if not some entertainment anyways, out of this video. It's great to be back in front of the camera again. If you've made it this far, I've got some news for you guys that I will be launching a website called millennialmoney.com.au. In that, I'm going to be posting about breakdowns of businesses, some personal finance stuff, so savings accounts and what I've been doing and what you can do to save a couple of dollars. But more importantly, because I've taken on a mortgage with my partner, there's going to be a monthly mortgage tracker, which is going to track our mortgage, because I think it's so important in Australia that not only are we making money through our investments, but also be looking over and paying off the mortgage that we're currently, living in and have to live with, because this is the mortgage that you pay with your after-tax dollars, and the interest rate isn't even tax deductible. So that's why I thought I would make something that would be more relatable to a lot of Australians, or just a lot of millennials, Zoomers, whatever, in general as well, who still or are going to be taking on a mortgage, and hopefully inspires some other people out there to pay it off as fast as possible. I'm definitely not going to take 30 years to pay off my mortgage. It's probably going to be 1/3 of that. And hopefully you guys join me along my journey. But anyways, guys, because I've got a new setup and I bought a brand new iMac, 27-inch. It's glorious, by the way, and hopefully helps me edit and gets more videos out there faster. Leave me some Apple emojis below. Otherwise, guys, I hope you guys have a great rest of the week. Take care. Cheers.